welcome everyone to another deep dive here. We love to really get into the weeds on these super important topics that sometimes fly under the radar. And today, we're going to do exactly that with something that's fundamental to our entire financial system, but maybe not something we think about every day. Payment systems.
Right.
The ways we move money around, whether it's, buying something online or getting paid by your employer or paying your bills. All of that relies on this kind of hidden infrastructure.
Absolutely. It's the plumbing of the financial world, so to speak.
Exactly. And what's fascinating is that the way these systems are designed and operated can have a huge impact on how efficient, how inclusive, and ultimately how well our economy functions.
Yeah, and that's where this deep dive gets really interesting. We're going to compare and contrast how different countries have approached this challenge. We've got some great sources here analyzing the central banks in the U.S., the U.K., China, and Brazil.
So we're talking about the Federal Reserve here in the U.S., the Bank of England, the PBOC in China, and the BCB in Brazil. Each of them has taken its own unique path, and what we're trying to understand is, what are those key factors driving these different speeds of adoption, particularly when it comes to real-time payments? Some countries have really embraced it, while others have been a bit more cautious.
Yeah, and I think right off the bat, the case of the U.S. Federal Reserve raises a crucial question. It plays this kind of triple role. It regulates all payment systems. It operates some of the biggest ones like FedACH and now FedNow. And it's also the main regulator of banks. So does this multifaceted role actually help to speed up innovation, or could it potentially be holding things back?
It's a great question, and it's something we're going to examine closely as we go through this deep dive. We're going to put the U.S. experience side by side with these other countries to see what lessons we can draw. It's about understanding how different regulatory choices, different operational structures ultimately affect you. It affects how quickly you can access your money, how much it costs to make a payment, and even the level of security and stability in the system. So it's really about getting a clearer picture of this foundational element of our financial world and seeing how it fits into the global landscape.
Yeah, and to do that, I think it's helpful to start with some basic definitions. When we talk about payment systems, what exactly do we mean? What are we actually talking about here?
Yeah, at its simplest, a payment is just an exchange of value.
Right, but there are two crucial parts to that exchange. You've got the transmission of the funds themselves, the actual money moving from one account to another.
Yeah. And then you have the information that goes along with it. Who's paying, who's getting paid, how much, and what's the purpose of the payment.
Exactly. And those information pathways can exist independently of the money flow. Take SWIFT, for example.
Yeah, SWIFT is primarily about messaging between banks. It helps them communicate about payments, but it doesn't actually move the money itself.
Right. But then you have systems like ACH, which combine both functions, the movement of funds and the transmission of information.
And these systems, they don't exist in a vacuum, right? They benefit from something called network effects.
Definitely. The more people and businesses that use a particular payment system, the more valuable it becomes for everyone already using it. It's a kind of self-reinforcing cycle.
Exactly. And on top of that, there are agglomerative externalities. And I know that sounds like a mouthful.
Yeah, but it basically means that when a new payment system emerges, it can actually create positive spillover benefits for the broader economy, even for its competitors.
So for a long time, the dominant way of processing payments was through batch processing.
You can think of it like a washing machine. You throw all your dirty clothes in together, and they all get washed at the same time, regardless of when you put them in.
And with batch processing, the bank essentially collects all these payment instructions throughout the day and then processes them in bulk at specific times.
And that introduces a degree of control. The bank has some leeway in deciding when and in what order to post those debits and credits.
And that's where it gets really interesting, especially for consumers, because that kind of discretion can impact things like overdraft fees.
Exactly. The bank could choose to post larger debits before smaller credits, or even reorder transactions, which can push your account balance below zero temporarily, even if you had enough money coming in later in the day.
And boom, you get hit with an overdraft fee.
Yeah.
It's this lack of immediate real-time processing that creates uncertainty and can lead to these unexpected charges.
And that's the fundamental difference with real-time payments.
Right. With real-time systems, each payment is processed individually and almost instantaneously. There's no batching, no waiting around. It's called real-time gross settlement, or RTGS, And it's a much more advanced approach that a lot of countries have been adopting in recent years.
Now, let's zoom in on the role of central banks in all of this, particularly the Federal Reserve here in the US. As we said, it has these three main functions: operator, facilitator, and regulator. And that facilitator role is really important.
It means they can encourage or even mandate the adoption of certain payment services, whether those are run by the Fed itself or by private companies.
But there's a tension, right, between regulating the entire payment ecosystem and also being a player within it.
And that tension is particularly pronounced in the U.S. because the Fed's regulatory reach is so broad. It covers all bank holding companies, state member banks, and even those non-bank sci-fis.
Yeah, and after Dodd-Frank, a lot of those non-bank sci-fis are actually payment organizations, so the Fed's influence over the payments landscape is pretty extensive.
And, to think about how that authority should be structured, one of our sources brings in the work of Paul Tucker, who was a big figure at the Bank of England. He lays out some key principles for an independent central bank.
Yeah, things like clearly defined goals, responsibilities, and powers that come directly from the legislature, and then transparent, mandatory procedures for making decisions, and finally, well-articulated operating principles to guide how they use their discretion.
And those principles raise some interesting questions when you look at the Fed's approach to payment systems. I mean, Congress has given them goals and responsibilities, but the sources suggest that maybe the Fed has used its discretion in operating those systems in ways that aren't always perfectly in line with what Congress intended.
It's a point worth considering. How has that discretion been applied in practice?
So why would a central bank get involved in running a payment system directly in the first place?
Well, our sources point to a couple of main reasons. One is economic necessity. Payment systems tend to have these characteristics of public goods.
Like natural monopolies, strong network effects.
Yeah, coordination challenges, asymmetry of information. In these situations, a free market might not deliver the best outcomes for society.
And that's where the argument for government intervention comes in, particularly through the central bank, which already has expertise in managing interbank financial flows.
The other main reason is systemic importance. Payment systems are so crucial to the whole economy.
They're the lifeblood, right? If they break down, everything grinds to a halt.
Exactly. So the central bank has a strong interest in making sure that those systems are reliable and function properly.
And the argument is that private companies might not always prioritize the broader economic consequences if something goes wrong. So a public option, like a system run by the central bank, can act as a safeguard.
However, as the Congressional Research Service points out, it's not a settled question whether a single provider, especially a government one, is always the best solution.
Yeah, there are trade-offs, right? Having multiple providers could actually foster competition and lead to lower costs for users. But it could also create redundancy.
And speaking of costs, the efficiency of these payment systems has a real impact on the wider economy. More efficient systems mean smoother, faster, and cheaper transactions, which is good for everyone.
Think about the rise of e-commerce. Platforms like eBay wouldn't have been possible without online payment solutions like PayPal.
And the entire app economy relies on seamless digital payments. But there's a potential dark side to this as well. Payment networks can become very concentrated.
Yeah, and that concentration can lead to what's called economic rent extraction. Basically, companies can use their dominant position to charge higher fees or extract more profits without necessarily providing more value.
And it can have regressive consequences, like with the credit card reward system in the US.
Where wealth is essentially transferred from merchants and lower-income consumers to those who benefit from the rewards.
Now let's shift gears and look at some specific U.S. laws that have tried to shape the payments landscape. One that stands out is the Expedited Funds Availability Act, or EFAA.
This was passed back in 1987, and it has this very clear language stating that the Fed shall, not may, reduce the time it takes for checks to clear.
And the intent was clear. As technology improves, consumers should get access to their deposited funds faster.
But Conti, Brown, and Wishnick make a really important point. They argue that EFA's mandate mainly applies to checks and ATMs, maybe wire transfers, but they question whether the Fed actually has the legal authority to mandate faster clearing for other types of payments.
They even point out the irony that this law, which seems like a push for faster payments, might have a surprisingly limited scope in today's digital world.
So even if we accept that EFA's focus is on checks, the question remains, why hasn't the Fed mandated near-instant funds availability for those checks and ATM deposits, given all the technological advancements we've seen?
Checks are not a relic of the past. In 2021, over 11 billion checks were written, representing a significant chunk of non-cash payments. So this law intended to speed up access to funds for check deposits still seems very relevant.
And then we have the Check 21 Act, which was passed after 9/11.
When air travel was disrupted, it exposed the vulnerabilities of a paper-based check clearing system.
So Check 21 allowed banks to process checks electronically using digital images. It definitely sped up the processing, but the regulations governing when those funds became available to you, those didn't really change.
And during the debates over Check 21, there was a lot of discussion about whether to mandate faster funds availability as part of the law. The Fed initially pushed back, saying they already had the authority under EFA to do that as technology improved.
But Congress ended up including a provision requiring the Fed to conduct a study on the issue.
And that study, released in 2007, concluded that despite the efficiencies gained from Check 21, no changes to the maximum hold periods under EFA were needed.
So even with digitized checks and faster processing between banks, consumers didn't necessarily get faster access to their money.
What's interesting is that the Fed estimated significant systemic savings from Check 21, over $1 billion in 2010 alone. And almost half of that went directly to the Federal Reserve System. They were required to return those savings to the Treasury, but the Fed's operating budget actually increased that year. It makes you wonder how those savings translated into tangible benefits for the average person depositing a check.
So all of this brings us to the Fed's entry into the world of real-time payments. In 2015, they created the Faster Payments Task Force.
With the goal of having a faster, more inclusive payment system by 2020, it was a big undertaking. Over 300 participants.
But it wasn't until 2018 that they asked for public comments on whether they should build their own real-time payment system. And then the decision to actually go ahead with what became FedNow, that wasn't announced until 2019.
With an eventual launch in mid-2023. So we're looking at a timeline of roughly 4.5 years.
Which does seem like a while, especially when you consider that other central banks around the world managed to implement similar systems in half that time or even less.
The Fed has said that this longer timeline is because of the sheer number of financial institutions in the U.S. Over 9,000 banks and credit unions.
But some of our sources point out that that explanation doesn't always square with the experiences of other countries that have also had to navigate complex financial systems.
And this brings us to the idea of structural conflict, as highlighted by Aaron Klein. The Fed's dual role as both regulator and operator of major systems like FedACH and FedNow creates this inherent tension.
Yeah, there's a potential disincentive for the Fed to create regulations that its own systems might struggle to meet. So could this dual role unintentionally lead to a bias towards maintaining the status quo?
And there's another layer to consider, the potential impact on back profits.
Right. Faster payments could reduce revenue from overdraft fees. And as our sources point out, that's a big source of income for many U.S. banks, particularly smaller ones.
So it's possible that the Fed, in its role as regulator, might have been hesitant to push too hard for changes that could hurt those banks financially. It makes you think about whether the structure of bank revenue in the U.S. has unintentionally become a factor in how quickly payment innovations are adopted.
Now, let's broaden our view a bit and look at some other countries that have embraced faster payments more quickly. Maybe there are some lessons we can learn from their approaches.
Absolutely. Let's start with the UK. They managed to develop and implement their faster payment system, now operating under Pay UK, in less than 2 years, between 2007 and 2008.
And by 2020, it was processing billions of transactions per year. It wasn't designed to be fully instantaneous from the get-go, but it generally allows for retail and small value transactions to settle within an hour, which is a big improvement.
And the Boston Fed did an analysis and concluded that the cost of implementing the UK system was relatively modest. Even taking into account the small benefits for individual users, the faster payment system resulted in a positive net present value for the UK economy.
Which really highlights the potential economic advantages of getting in early. And the driving force behind this rapid implementation in the UK was actually Her Majesty's Treasury and the Office of Fair Trading, with backing from the Bank of England, including then Deputy Governor Paul Tucker.
And here's a crucial difference from the U.S. model. At that time, the Bank of England wasn't the primary regulator of payments, and it wasn't the sole regulator of banks either. They had a Twin Peaks model, with the Financial Regulatory Authority handling bank supervision. So the Bank of England could really focus on the big picture, economic growth and efficiency.
Yeah, and without those potential conflicts that can arise when the central bank is both operator and primary regulator.
Now, initially, there were concerns in the UK that the benefits of faster payments weren't reaching consumers. Even though the technology was there for near instant transfers, some financial institutions were still delaying things.
So in 2012, they introduced regulations mandating faster funds availability. They wanted to make sure that consumers actually experience those advantages.
And the analysis of those early challenges in the UK pointed to the limited regulatory authority of the Payments Council at the time. It seemed like the biggest banks, who were joint owners of the main payment scheme companies and had a lot of sway in the Payments Council, were effectively blocking initiatives that would benefit society as a whole.
Because those initiatives didn't necessarily align with their own narrower business interests, it was the most established players dictating the pace of progress.
And the UK's solution to that was pretty decisive. In 2013, they created a brand new regulatory body, the Payment Systems Regulator, or PSR.
And this new body had full authority, its own objectives, its own management structure.
It was specifically tasked with promoting competition, innovation, and protecting users of payment systems.
A clear separation between regulation and operation. Now let's hop over to China. Their approach was quite different.
The PBOC, which is the People's Bank of China, had the legal power to both regulate and operate payment systems. But they largely let innovation happen outside the traditional banking sector.
And that led to the explosive growth of mobile payment platforms like Alipay and WeChat Pay.
Using QR codes and smartphones, these systems have become dominant in retail payments across China.
And this was in line with a broader government goal of promoting innovation. And it was also helped by the fact that Chinese banks weren't as reliant on payment system revenues compared to banks in some other countries.
Another key factor in China's rapid shift was the lack of a deeply entrenched card payment system. For various reasons, merchants largely resisted adopting fee-based card networks, even when the fees were relatively low.
So consumers are basically stuck using cash for most transactions.
Oh.
And then mobile payments came along and offered this really compelling alternative. They were fast, accepted everywhere, inclusive, and the transaction costs were low.
So they appealed to both consumers and merchants.
Now, finally, let's look at Brazil. The Central Bank of Brazil, or BCB, showed some really strong leadership in developing and implementing Pix, their real-time payment system.
Which launched in 2020.
And what's interesting here is how the BCB used its dual role as both regulator and operator to really align Pix with its policy goals and get it widely adopted in a very short amount of time.
They prioritized national economic benefits and financial inclusion.
And unlike in the U.S., where the Fed's dual role is often seen as a potential source of conflict, the BCB used its authority in a very assertive way. They even mandated that key financial institutions participate in Pix.
And the Bank for International Settlements actually pointed to the BCB's dual control as a positive factor in the rapid success of Pix.
It's interesting, right? Because here in the U.S., that dual role is often seen as a reason for the Fed to be more cautious.
The BCB initially encouraged private sector innovation in payments, but when that wasn't moving fast enough, they stepped in and took the lead in developing and implementing Pix. It's a stark contrast to the more deliberative approach in the U.S.
So as we wrap up this deep dive, the differences between these countries are pretty striking. The UK separating regulation and operation, China fostering non-bank innovation, Brazil with this assertive central bankload approach. All of them resulted in much faster adoption of real-time payments compared to the U.S.
And as we've discussed, the structure of the Fed, with its multiple roles and potential conflicts of interest, seems to have played a big role in the slower pace here in the U.S.
Faster payments, especially those driven by the private sector, could be seen as a threat to the Fed's operational role. And they could also affect bank profits by reducing reliance on things like overdraft fees.
And ultimately, people and businesses in the UK, China, and Brazil are now experiencing the benefits of faster, more efficient payment systems, benefits that often help lower-income households and small businesses the most.
Here in the U.S., we're still dealing with slower processing times and, in some cases, higher costs.
And it raises a critical question. How much of this difference is due to specific policy choices versus the inherent structural conflicts within the Federal Reserve? The evidence we've looked at today suggests that the latter has played a significant role. Perhaps the Fed hasn't always fully used the authority that Congress has given it to push for faster payments.
So, given what we've seen in other countries and the potential advantages of faster payments, it's worth asking, What changes to the U.S. central banking structure or regulatory priorities might be needed to really spark more innovation and efficiency in our payment system? What could lead to a better financial experience for you and for the U.S. economy as a whole?
It's definitely something to think about.
Thanks for joining us for this deep dive into the world of national payment systems.
The key takeaway here is that how a country's central bank is structured and what its priorities are, those things have a huge impact on how its payment infrastructure evolves.
And the U.S. faces unique challenges because of the Fed's many different roles.
We encourage you to keep thinking about the implications of these different approaches and what the future might hold for payments in the U.S.
And as always, we invite you to explore the sources we've discussed and do your own research on this crucial and fascinating aspect of our financial world.
Thanks for listening.
See you next time.